Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today we're going to take a look at TKO Group, ticker TKO, great ticker for a fighting company. And these guys own UFC and WWE. They just started trading when Endeavor merged UFC with WWE and spun them off into its own company. Endeavor still owns 51% of this company, so they still have a controlling interest. But the price point is getting interesting as the stock has fallen about 25% since it started trading in a short period of time for a variety of reasons. But sometimes I like these pure sports plays. Often they trade at a multiple that's greater than just the sum of its financial parts. I look at something like Formula One, a stock I also own and have done very well on. If the popularity starts to skyrocket or sticks around or gets better, they can utilize that to negotiate much better media rights, and that could really help boost the financial profile of the company. So even if it trades at a multiple that's better than the market, most times, if it does fall into a reasonable multiple range, that could make for a very attractive long-term return. And this is a company that actually generates pretty good financial returns in terms of free cash flow, EBITDA margins, etc. So this is the transaction overview. Like I said, still owned primarily by Endeavor, which is also a public company, EDR, that you can own this through as well. But I'd rather just own the pure play public company if I'm going to own it. At the time of this transaction, when it was released in April 24 and consummated in September, this was a 21.4 billion enterprise value company, most of that coming from UFC. Now it's closer to 15, 16 billion. The one main issue I see is there's a lot of debt here, and unfortunately, most of it is variable debt, so that's a bit of a problem they're going to have to work on in the next couple of years because that's going to hit them. The idea here is when they acquire WWE, they can kind of take their Endeavor playbook that they applied to UFC, get synergies involved, negotiate better rights, use the Endeavor flywheel to kind of improve sponsorships, etc., improve margins, and get a better EBITDA at the end of the day. UFC's EBITDA margins were north of 50% in 2022. WWE's were 20% lower than that. So if you can kind of trend that WWE margin up a bit, that's going to help cash flow quite a bit and going to help the bottom line quite a bit. So I'm going to skip a bunch of this stuff. You can kind of see the growth for UFC, 2x EBITDA growth since 2017, 3x EBITDA growth for WWE since 2017. Both have 1.5x revenue growth since 2017. Now, this is primarily a media rights play. Both of these businesses, 70% plus of their revenue comes from media rights, and that's a good and bad thing because the market is going to move this stock one way or the other depending on how those media negotiations go. And one of the reasons that TKO is down as much is because there was a negotiation for WWE SmackDown, one of their prime shows. Fox was paying $205 million for the rights to air that weekly. It's moving to the USA Network for $285 million or something in that range, which seems like a lot. It's a 40% bump, but it's not just WWE SmackDown that USA is buying. WWE is going to make 4 primetime shows for NBC along with that, so it's kind of not an apples to apples comparison. On top of that, the market was expecting more than 300 million per year just for WWE SmackDown. So it's kind of a letdown because these deals are negotiated for 4 to 5 years at a time. So it's going to be 285 million in 24-25, but also 285 million in 29-30 or whenever the deal runs through. So costs are going to go up in that time frame, but revenue is not going to go up. UFC, for example, has a deal with ESPN that runs through 2025. It's 300 million per year for the rights to air most of their stuff. What's going to happen when those rights come up for negotiation? Right now, WWE is negotiating Raw and Next, which I think is a 450 million per year rights deal right now, and the expectations are that it could go as high as 700 million plus. So if those deals don't work out as well as expected, this stock could take a further hit because so much of their revenue comes from those rights deals. Now, obviously, if the popularity of UFC ticks up, the popularity of WWE ticks up sometime in the next couple of years, these rights could be a huge boon for the company as well, but present a lot of risk if the reverse happens. I think WWE is a lot less popular than it used to be. UFC is still certainly popular, but rights do drive the valuation of the business and can see huge increases depending on how the sport is going. For example, Formula One renegotiated their rights recently. It went from 5 million per year for ESPN to 95 million per year, and that will probably go up even more in the next negotiation. Right now, WWE has a streaming partnership with Peacock. It's like across 5 years for $1 billion, which I think is probably undervalued, and they may get a better deal in the future. But a lot of these are uncertainties, and so much of this business is dependent on those media rights negotiations that it certainly puts a bit of risk into the business model. And you can see why UFC and WWE is a good business to be in, because essentially they own everything when it comes to the business, right? There's no teams, there's no owners, the content is year round. If you think about the NBA and the NFL, there's teams, there's player rights that are very good where the players share about 50% of the revenue. Right now, the player rights are really bad in the UFC and the WWE. The revenue sharing is like 10 to 20% versus 50% in a lot of these other leagues. And maybe that's a risk for UFC and WWE. If that changes, if these players unionize, if they demand better pay, that's a risk to the bottom line if you're a stock owner. So that's something to think about as well, because it's so different than some of these other leagues. And while that may be a good thing for investors, it's not necessarily a good thing for the fighters within and the athletes within both of these leagues. So interesting investment thesis here, right? You're essentially saying that UFC has grown a lot under Endeavor, and Endeavor is going to bring those capabilities to WWE and improve the bottom line results as well as the top line results for WWE. As a merged company, there's annualized cost savings they can make. There's a $1 billion cost base that they think they can address. So they're expecting 50 to 100 million in a long-term annualized rate in terms of operating synergies. And they can do that pretty quickly, they think. And on top of that, it's a financially healthy model. 2.4 billion in revenue in 2022, 1 billion in EBITDA, 600 million in free cash flow. Leverage isn't bad, but it's actually kind of bad. Like 2.5x leverage doesn't seem bad. We'll talk about why it's bad, but it is a free cash flow generative business. They're going to do that to invest in the business, deleverage more because they have to, because their interest rate sucks. There's going to be capital return, whether it's dividends or buying back shares. And then there's M&A. They've talked about how this isn't it, right? This isn't all they want this business to be. It's not just going to be UFC and WWE forever. They're going to acquire more leagues, potentially more sports. We'll see what that means. But I think in the short term, they kind of have to pay back their debt, because while their debt doesn't look that bad on the books, it's not all that ideal when you actually look at the details. And why is this stock down so much? Well, one, the rights deal wasn't that amazing. I think it was still decent, but it wasn't what the market expected. And two, interest rates continue to rise. And interest rates do affect this business quite a bit, because most of their debt is variable at the moment. Their interest rate is something like 8.2% in 2023. Their interest expense is going up by like $80 million in 2023, so 70% because of that variable interest rate. And so that debt on an EBITDA basis, they have $1 billion in EBITDA versus 2.7 billion in debt. Doesn't seem too bad, but they're going to have to pay that down quickly because the interest rate is quite terrible. So as I look at the financials, I kind of look at some of these estimates. None of these estimates are fantastic. When it comes to these like merger acquisition type things where it's a spin-off with a merger, finding data isn't very easy. So I kind of had to scrap this together from some of their filings. I think that's one of the reasons the stock is beat down a little bit. It's hard to understand exactly what's happening, how many shares out there. I think this is a pretty good estimate, but could be some mistakes here. Keep that in mind. As always, disclaimer, video purely for informational, educational, and entertainment purposes only. It's not investment advice. Do your own due diligence. I will put this valuation spreadsheet in the link down below, in the description down below rather. So click on it if you want to play around with it, hit file, make a copy, but be aware, could be some errors here. Some of these estimates are probably a bit funky, because not a lot of guys are looking at this quite yet. Not a lot of analysts are looking at this quite yet. So that's why the stock is kind of underassessed, potentially undervalued, always potential for some good valuations, good long-term returns when it's these stocks that don't have a lot of eyes on them. So I wanted to take a look at it. And also the fact that this is a unique asset might be worth exploring. I'm kind of taking a look at what's going to happen in terms of revenue in the next couple of years. And the revenue here is going to be hard to predict because it's so dependent on, how many live shows do they have? How well do those do? What kind of sponsorships can they get? where are their contract rights in terms of when do they kick in, when are they being renegotiated? So revenue increases might be a bit lumpier than this. For example, 24 and 25, some of the new WWE stuff will kick in. So I'm kind of seeing some bumps and increases there. Then some of the UFC stuff might kick in. I don't really have a good line of sight into their international rights, when those are negotiated. The domestic rights get a lot of news announcements, but the international rights are sometimes a bit over the place. So I'm kind of doing 7 to 9% increases for the next couple of years, a bit of an uptick in 24 and 25 that continues into 26 and 27 because of some of the new rights that are going into play. A bit of a margin tick down in 23. Some costs of becoming a public company, merger costs, etc., that are going to impact their bottom line margins, but that kind of ticks back into what they saw in 22 by 2024. And then I'm assuming a little bit of an increase into 25, 26, and 27. I think that's a bit of a risky assumption for a couple of reasons. And the main one is, one, they have 2.6 billion, 2.7 billion in debt. There's some cash on the books, some capital leases, and that doesn't seem that bad, but there's some risk here. One, there's a interest rate of about 8.2% on the debt, as far as I can tell. It's hard for me to actually calculate it because they didn't specifically list this is our debt interest rate, but I'm just kind of taking their interest expense versus what their debt is. But you can kind of see that their interest expense is up 101% for the first 6 months of 23 versus 22, and that's because they have a lot of debt on a variable rate, and that variable rate is going up as the 10-year treasury goes up, as the LIBOR goes up, and that's a bit of a problem. So if they're sitting on an 8.2% rate, they want to pay that off as fast as possible, and or they want to refinance it at least a fixed rate that's not going to kill them. So if interest rates stay elevated, their interest expense is going to be high, which is a bottom line cost, right? If they're essentially seeing a $70 million increase in interest rate expenses into 23 versus 22, that is going to hit 23's bottom line quite a bit. And if they don't start paying that off quickly, it's going to impact their ability to actually grow this margin into 26, 27, etc., as I'm projecting here, because there are going to be cost synergies. But if you're expecting 50 to 100 million in cost synergies, but your debt cost is expected to go up by 80 million, what's the point of these cost synergies? You're essentially back at square at nothing, right? That's kind of the issue. On top of that, all of this debt seems to be due in 2026. So they're going to have to partially pay it off and partially refinance it. Now they're a company that is bigger now than they used to be. UFC, this is UFC standalone debt. I don't know why Endeavor had this debt not on a fixed rate, but on a variable rate. Maybe their fixed rate wasn't all that amazing because it was UFC, because it was a smaller business. But was it 8.2% or higher? Is this just bad management that they took this out on a variable rate when they could have done it on a fixed rate? So they're kind of saddling this new company with a lot of bad debt, essentially, that's due relatively soon. So a lot of this free cash flow, the 3.8 billion that they're potentially going to generate, I'm not really assuming a big buyback. I'm not really assuming a dividend or anything like that. They're going to be paying down debt as much as they can, and they should be. That's really what they should be doing. You can kind of see that their credit facilities here very much variable. One of the main risks they point out is that, hey, we have variable debt as of 2022, a 1% interest rate increases annual interest expense by $28 million. So, if it goes up a couple percent, that's a lot more than $28 million. You can kind of see that in the first 6 months, they already paid $112 million in interest expenses versus $139 million in the full year for 2022. So they're going to pay 230 million for 2023 versus 130 million in 2022. So that's going to eat up all of those cost synergies they claimed are so fantastic. That is a risk. The 2.6 billion in debt being due in 2026 is a risk. The good thing is that a lot of their revenue is contracted. 75% of their revenue is media rights. They're going to pay that no matter what. It's sort of going to happen. They know they have good visibility into their revenue. They can control their cost basis if there's some issues to really pay down debt. I'm not super worried about like bankruptcy or anything like that, but I am worried about their ability to increase their margins, which is what they need to do to sort of elevate this valuation beyond what it is today. And that's why I think that's why the stock is down. Debt sucks, but also their rights negotiations aren't that amazing. WWE Raw, I think, and Next are up for negotiation next. Right now, those are like 450 million a year rights. The expectation is that they could get 700 million for those. If they can do that, that's fantastic. That's a good thing for the stock. But if it's less than that, will the stock react negatively? If it's more than that, the stock should react positively. But yeah, there's been rumors about Amazon, Netflix, other streaming players being involved in those negotiations. Who knows where it'll go? After all, SmackDown went to USA Network. Not exactly the most pristine cable network these days. I think that's one of the reasons the popularity of WWE has waned. It's kind of on this random network. Who has cable anymore? And most of all, who watches USA? So people who are fans of WWE already are probably watching it on USA or Fox or wherever it's at. But if you're not, are you really finding it? It might be a good thing for it to show up on a streaming service as a marquee thing that they actually promote. After all, Amazon is getting into sports. Do they consider WWE a good enough sport, a marquee sport, whatever? So as far as valuation goes, I'm putting 65% of the valuation in the 5% free cash flow yield. Right now it's trading about 4.5%. So I'm 20% into 4%. 15% into 6% to be a bit more conservative. On that basis, the expected revenue, inclusive of the no dividends and the buyback that they're going to, that I'm assuming here, is about a 9.3% return from today's price point at 76.57. If I want a 15% return, which I sometimes target with some of these riskier stocks, that's a fair value of 59 bucks. Now, if you're closer to 10%, you're basically right where it's trading today because you're getting a 9.3% return at today's price. To me, that seems reasonable if you think sports are the future and these rights are going to go well and they'll have a no problem paying off their debt. I'm a bit worried about their debt being as high as it is. I'm a bit worried about the uncertainty of those negotiations. Obviously, streaming was like booming 3 years ago. Now it's a bit less boomy. So these companies are cutting back on costs. Are they going to be as willing to pay a ton of money for these rights that WWE and UFC has? Maybe their right negotiation increases are going to go down quite a bit in the next couple of years. So maybe these increases on the revenue side are a bit optimistic. Are they going to be able to improve their margins when their interest expense is increasing so much year over year if interest rates stay elevated? And this morning stocks are down because there's talk of further increases, so that's going to further increase their prices that they're paying on their debt, because this is variable debt and it goes up and down with interest rates, and the 10-year is now at 5%. So you kind of have to think about that as you look at this from a margin perspective. So as I look at this, if I'm targeting a 15% return at these scenarios, I need a price point of 59 bucks, which is 22% off of where it is today. Now, maybe that's a bit pessimistic. As I look at Formula One, sometimes those assets trade closer to that 3 to 4% free cash flow yield because they're marquee assets, because they're unique, because they're more than just the value they bring. If some rich guy wants to own a sports league, maybe they want to pay more for the WWE and the UFC than just the valuation of its free cash flow. That's why people pay, $7 to $8 billion for a sports team, right? And over here, you're getting two entire sports leagues, and you can argue whether or not the WWE is a marquee sports league or if it's a sport at all. It totally is. These people are total athletes. Maybe it's not real in terms of the stories being pre-planned, but these guys are athletic AF. And the UFC is definitely a sport. So if you're looking at that 3 to 4% free cash flow yield, total returns can be in that 13 to 20% range. And that's, assuming these margins, maybe they're a bit conservative. If you think about UFC's margins as a standalone entity, they're probably at 30% free cash flow margins plus, right? You talk about 60% free cash flow conversions, 55% EBITDA margins, that takes you to the mid 30s. If they can really do what they did on UFC, on the WWE side, can those margins get into the 30% range? I think if you think that that's true, if they can pay down that debt, refinance the rest of it at a fixed rate that's maybe lower than the low 8%, mid 8% now probably, this could be a really good return. So I can see why people would want to invest in this at this price point. To me, I'm sort of getting there. I'm sort of getting there where maybe my assumption here is a bit too conservative. Let's say I put 0% here and throw it into 15% in that 3% range. And now it's an 11.5% return and a fair value of 66 bucks at a 15% return. And that maybe makes sense because, again, this is a unique asset. It's a trophy asset in my mind. It's misunderstood by the market. They don't really know what they're getting, and I get why not. The debt picture is a bit unclear. The contract picture is a bit unclear. But I'm getting to a point where I might just get a starter position here because I do like and have made a lot of money on Formula One stock. Own a bunch of that, FYI. Full disclosure there. Don't right now own TKO, but I might put a price point that is sort of in the middle, sort of probably in that high 60s, low 70s range as, hey, if this stock hits low 70s, am I going to start a position? I think so, because this is interesting. And I like interesting plays. I like plays that could be misunderstood by the market. I like plays that have a ton of upside if contract negotiations go their way. There's certainly some downside here, but I don't think the downside is tremendous. I think the downside is that, they're going to spend a lot of time in the next couple of years just paying down debt because debt is a major overhang here. Once they get a handle of that, even if the contract negotiations aren't that 50% to 60% increase that they're expecting on SmackDown, that they didn't get on SmackDown, even if they get 30 to 40% on Raw and Next and their next UFC negotiations, I think this could still be a 10% plus returner if you're buying that in that low 70s range, 15% plus if you're buying that into that high 50s, mid 60s range. So seems interesting to me. It's a unique opportunity. Right now I'm not a buyer, but I'm going to set an alert in the low 70s and probably start picking up a position. What do you think? I know this is a unique stock that you probably haven't looked into, but let me know what you think about TKO. Like the video if you enjoyed this video. This isn't one that I do all the time, but I like looking at these unique investment opportunities that don't necessarily get a ton of coverage because I couldn't find a ton of coverage on this stock. So I decided I wanted to do some of my own. Hope you enjoyed it. Like, subscribe. Let me know what you think in the comments down below. Bye.